And welcome to the OANDA Market Pulse charting analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now today we'll start with dollar yen because we've highlighted this currency pair previously. We have had a break of 180, those 118.65 levels. We saw it obviously tested a couple of days ago on Monday, and we have seen that broken today. Now initially this is only likely to open up a small move, maybe back towards these 118s, which could provide some support. You could see this is the previous support from the 15th of October. We came near these levels again back in February and in March. So really, aside from this initial spike that we had back in August, these are the lowest levels we've really seen for most of the last 12 months, maybe around the last 11 months. So I think this could be quite a substantial level around these 118 levels, so it's worth keeping an eye on. 118 to 118.25 by the looks of things, and again this combines with these lows from early on last year. If we see these levels broken, I do think this is going to be more substantial. I do think if we look at the larger charts, this could potentially open up a move back towards these levels here. Again, 115.50 to 116. Not only is this the lows from that spike low back in August, but they're also the lows from January last year and also December the year before as well. So these are some quite substantial levels. Of course, 117 may offer some support along the way. Again, it's one of those numbers. It's a round number. It could potentially be a key psychological or a psychological level. We've also got these price support again that we saw back in January and February last year. But I think 115.50, 116 could be key if we do see these 118 levels broken. So I think this is certainly one to keep an eye on in the shorter term. The next currency we want to cover is the Australian dollar. Now the reason why I wanted to touch on this is because we have seen it come back quite significantly today. Obviously seen a lot of interest, short Aussie interest against the dollar, today. The reason I wanted to highlight it really is because the Australian dollar had been looking long ever since we broke out of this long-term descending channel, going back to pretty much the middle, third quarter of 2014. Now, I've said repeatedly that while the momentum gain since we saw that breakout wasn't that significant, seemed to be lagging somewhat, which made me question just how substantial this break was going to be. Since then, we saw it test these previous highs from October, failed to break through them. Now we've made lower highs off the back of that, so that's a bit of a bearish signal, maybe suggesting that we're only going to see, rather than this being a significantly bullish break from this descending channel, maybe this is just a sign that we're going to see some sideways trading. Now we've seen it pull back to this this shallow ascending trend line, I must say, but it is effectively a speculative trend line, only 2 touches here, but we have seen it find support here, so this is around these 70-50 levels. If we can see it break below here, that would be quite a bearish signal, because already now we've had lower highs and lower lows in this pair, which may suggest that we are going to continue to see this edge lower, potentially grind lower, much slower than we had previously, but it certainly goes against the suggestion that maybe this break above the descending channel was bullish. I think we do have a clear ceiling here at this stage around the 73.80 levels, but I think a break below this 70.50 level could potentially prompt a move. Well, of course, we've initially got this support around 70, again, a nice psychological level, but I think we could potentially see a move back towards these 69 to 69.30 levels should we see this ascending trend line broken. Next, I want to focus on commodities. So we've got WTI, of course. We've seen a lot of movement in WTI today. Brent as well, of course. We see similar moves in both of these. We are seeing this trade down quite significantly today. Now, of course, this 3% decline that we've seen in WTI Crude, it sounds quite significant on a percentage basis, but in absolute terms it's actually still quite small. It's just because, of course, we've just seen such a significant sell-off in it that these smaller moves, or what is previously perceived to be a smaller move, is actually far more substantial. But what's interesting here is we are trading back at these $34 levels. We've highlighted previously that we are in this range at the moment between $34 and $37. We have seen some sideways trading really over the course over the last month or so, but we are seeing this support now coming back under pressure. Now, what's extra interesting, I guess, about this is that if we look at its counterpart, Brent Crude, we've actually seen this support level broken. So now Brent Crude is actually trading at multi-year lows, having broken through 35.60 today. the fact that we've seen this break below here and break through another support around 35 to currently trade around 34.50 suggests to me that WTI may just be lagging a little bit, so we could see this come under further pressure today or in the coming days. And if we see this level broken, this $34 level broken, then I'd be looking back towards these 32.25. But to be honest, the next substantial level for me, if we do see 34 broken, will be 30. I think this is going to be key now. I think if we are looking at multi-year lows at this stage. If these levels are broken, you really do have to go back all the way to 2004 to see these previous levels, and you can see that 32.20 I think is it 32.25 was a notable level when we were last trading down at these levels. Again, let me just take you back all the way to 2004. This was the prior low back when we were trading February 2004 below here. Again, 30 was a notable level, not just because it was the prior low prior to this from November 2003, but also you can see, of course, it is a key psychological level again, $30 a barrel, but you can see that throughout 2003 this was quite a notable level as well. So this will be the next one we are keeping an eye on here. And again, like I say, with this $34 coming under pressure, it could come sooner than we potentially think. Gold is next, and again, we are trading at quite a key level for gold because we've seen it range bound, like as with a number of things that we've highlighted already. These have become range bound following such substantial sell-offs. Now, what's interesting with gold is we are trading back at these 1090 levels. Now, of course, 1100 above here would be a notable level again. I seem to keep saying this, but a psychological level. But we've seen this repeatedly again. September the 11th here, November 16th. Again, we saw 1100 was key support and resistance. But at the moment, 1090 seems to be quite more notable for me at this stage. During this period here, around that 1090 level seems to be quite a substantial level of support. Of course, it was broken on a number of occasions, but it did tend to often close above this level, barring this couple of day period here. But again, once we broke below 1090 again, every time we saw some pressure to the upside, 1090 seemed to be the level at which the market started selling into it. So we're trading back at 1090 now here. We're still at 1050 to the downside of support, but also adding to this resistance could be the 50-day simple moving average. Now, the 50-day simple moving average is, of course, quite a well-known one to technical traders. What I quite often do is look back to see how the market's reacted to it previously. Now, throughout this period, this sideways trading period and this sideways trading period, there wasn't much respect for the 50-day moving average. When we saw this decline back here, we did see a little bit of respect for it here. And again, if we look earlier on when gold was more range traded, say back in 2012, early 2013, you could see that it was a nice level of resistance all the way down after breaking below here back in October. So a bit of a mixed bag, really. I think it's not quite as clear cut as you can quite often see on some charts. The fact that it coincides with a prior level of support, current level of resistance, though, that's what makes it significant for me, because it's an additional possible resistance level for gold. So if we see it break through here, this could be quite substantial, although if we do see it break through this level, maybe we'll see it move back to 1100, and then that'll be the key test for me next. If we can see 1100 broken, then that could be quite a bullish signal for gold, at which point we could be seeing ourselves headed back towards these 1190. Well, initially maybe around these 1150, but maybe even as high as back up towards this descending trend line, this long-term descending trend line, I should highlight, from May 2013, and also coinciding as well with October last year highs. But again, getting a little ahead of ourselves. I think 1090, 1100 in the short term are going to be some key levels. Finally, I just want to touch on copper. Now, we haven't seen any breakout here, but one thing I wanted to highlight with copper was the fact that we are range traded, although we are seeing some mild consolidation following this prolonged period of selling. Now, we do find ourselves in kind of a bit of a flag formation, although it's a very shallow flag, so I think this is more just consolidation rather than a bearish continuation pattern. There's also more than 20 candles, I believe, in this setup, although I haven't counted exactly, and usually when you go beyond 20 candles, that tends to suggest that it's not necessarily a technical setup, but it's just more consolidation or sideways trading. But what makes this interesting is we are obviously seeing clear pattern here, given the consistent higher highs and higher lows at the same trajectories. But what could be interesting here is if we move back towards these 220 levels, prior levels of support. We've also got the 89-day simple moving average that comes into play here. Now, the reason why I use 89 is quite often on my charts I'll try to customize my moving averages to the best of my ability, using prior trends effectively. If the markets are responding to a certain moving average during the previous trend, then I'll tend to pay more attention to it. But if the more common moving averages aren't working, the 50, 100, 200, then I will try to play with them a little bit. And one thing I've found can sometimes work is Fibonacci numbers. Again, Fibonacci plays a key part in technical analysis. So using this, I've tried to play with it with when the common moving averages aren't working. And in this case, I found 89 to be quite a reliable daily moving average. You can see, of course, here resistance, resistance, almost ran into resistance a little bit here. Again, ran into resistance once it broke below support during this period. It seems to be fairly reliable, so it's something that I'll be monitoring again once we move back towards these 220 levels, or if the moving average comes back a little bit lower, then I'll be paying attention towards it again. But right now we are seeing, I'd say, range bands. If we see a break higher, this could be quite bullish, and if we see break lower, it could suggest we're going to see a continuation of the downtrend, bringing $2 back into consideration. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you in your trading.